All right, let's just jump right in. Imagine this. A chunk of money just lands in your lap. Maybe it's an inheritance, a big bonus from work, or you sold something valuable. Suddenly, you've got this classic high-stakes question that, honestly, it freezes even the most experienced investors out there. So, what do you do with it? Do you go all in right now? A big lump sum investment? Or do you play it a little safer and kind of ease in, spreading it out over a few months? That's what people call dollar cost averaging. And look, this choice feels huge because how you answer this really can have a massive impact on your financial future. What's so fascinating is that your answer to that question, it really reveals this core conflict in all of modern investing. It's basically a showdown between two powerful forces, the cold, hard math and your own mind. So let's break down this battle, shall we? Okay, first up, the case for all in. Let's just look at what the unemotional numbers say. If we take all the feelings, all the anxiety out of the equation, well, the data tells a really, really clear story. And look, the evidence here, it's pretty overwhelming. If you look at historical data from pretty much every major global market, investing all your money at once, the lump sum, it beats spreading it out about 68% of the time. Now think about that. That is not a coin flip. That's a huge statistical edge. It's like stepping up to bat knowing the pitcher is going to throw you a meatball 2 out of every 3 times. So, just so we're all on the same page, let's be super clear about what we're comparing here. Strategy A, the lump sum. All your cash gets to work on day 1. Boom. Strategy B, dollar cost averaging or DCA. A big chunk of your money is just, well, it's sitting on the sidelines, waiting its turn to get invested month after month. And this really shows you the cost of all that waiting. A big study from Vanguard found that, on average, a lump sum investment just flat out outperformed a 12-month DCA plan. You see it right here. For a pretty standard 60-40 portfolio, you're looking at a 2.3% higher return. Now, I know 2.3% might not sound like a life-changing number, but trust me, over time, that little gap, it compounds into a serious amount of money.
So when you boil it all down, the math is telling us something really simple. Markets, over time, tend to go up. That's just what they do. So every single day you keep your cash on the sidelines, you're essentially making a bet against that long-term trend. And, as all this data shows, that's a bet you are probably going to lose.
Okay, so if the math is that clear, you got to be asking, why doesn't everyone just do it? Why is this even a debate? Well, it's because we're not robots, right? We're human, and our brains are wired with these really powerful biases that are basically screaming at us to slow down and be careful. And a huge part of this comes down to something called loss aversion. Get this, researchers have found that the pain you feel from losing a dollar is about 2.5 times more powerful than the pleasure you get from gaining a dollar. I mean, just let that sink in for a second. That fundamental imbalance in our brains, it drives so many of our financial decisions or indecisions. Okay, let's play this out. Scenario 1. You go all in. You invest that entire chunk of money. And then, the very next week, wham, the market drops 10%. How do you feel? It's just this immediate gut punch of regret. You feel foolish. You feel like you made this horrible, irreversible mistake. Now let's flip that. Scenario 2. You decide to ease in slowly. The market drops. But wait, you've only invested a little bit of your money. The rest is safe in cash, and now you get to buy more shares at a discount. In this scenario, you don't feel foolish. You feel smart. You feel like you dodged a bullet. Your brain is literally rewarding you for picking the path that minimized that awful feeling of regret. And it's not just loss aversion messing with us. We also have something called recency bias. You know how it is. Our brains can perfectly replay those scary headlines from the last big crash. It feels so vivid, so real. But the long, boring periods of steady gains, we kind of forget about those. This all feels that paralyzing fear of, what if I invest right before the next big one? That feeling alone is enough to make a lot of people choose the path that feels safer, even if the math says it's not the best one.
But, it's not quite that simple. This isn't just a straight-up fight between the numbers and your brain. The real world is way more complicated, and there are some other really important factors that can and probably should change how you approach this whole thing.
First and foremost, your time horizon. This changes everything. Think about it. If you're 30 years old and you invest a lump sum right before a market crash, it stinks, for sure, but you have decades to recover. But what if you're 65 and you're just about to retire? A big loss right at the start can be absolutely devastating. That's what's known as sequence risk, and it's a huge deal. For someone facing that kind of risk, easing in with DCA, well, it suddenly looks a lot more defensible. And then there's taxes. They can totally change the game. If you're investing inside a tax-advantaged account, like an IRA or 401k, the lump sum math usually still wins. But if you're in a regular taxable brokerage account, DCA has this kind of hidden benefit. Because you're buying in smaller chunks over time, you end up creating different tax lots at different prices, and that can be a really powerful tool for managing your tax bill.
This tool is called tax loss harvesting, and it's pretty much what it sounds like. You strategically sell an investment that's lost value to harvest that loss on paper. Then, you can use that loss to cancel out the taxes you'd otherwise have to pay on your winning investments. So, by creating all those different entry points, DCA just gives you more opportunities to find and use these valuable losses, especially in a choppy market.
All right, so we've talked about the math, we've talked about your brain, and we've talked about the real-world wrinkles like age and taxes. So the big question is, how do you take all of this theory and turn it into an actual plan of action? First things first, let's be absolutely clear about what the real enemy is here. It is not picking the wrong strategy. It's not choosing DCA when a lump sum would have earned you a tiny bit more. The biggest risk, the biggest mistake you can make is analysis paralysis. It's getting so stuck on this decision that you do nothing at all. And your money just sits in cash for months, maybe even years, while the market just keeps climbing without you.
So for a lot of people, the best answer might actually be a hybrid approach, one that kind of respects both the math and your mind. It might look something like this. You invest a big chunk right away, say 50 or 60%, to get most of that lump sum advantage. Then you invest the rest over a pretty short period, maybe 3 to 6 months. You could even set a trigger to invest the rest if the market dips. But here's the key: automate the whole thing. Set it and forget it. That way, you take emotion out of the driver's seat and you can't second-guess yourself every day.
So if you want a really quick and dirty checklist, here it is. You should probably lean towards a lump sum if you have a long time horizon, you're okay with risk, and you're investing inside a tax-advantaged account. On the other hand, you might want to seriously consider DCA or that hybrid approach if you're getting closer to retirement, if you're kind of new to investing, or if you're in a taxable account where you want that tax flexibility.
And this brings us to what might be the single most important idea in all of investing. I really want you to hear this. The perfect strategy that you can't psychologically stick with is always, always worse than the good enough strategy that you can actually follow through on. Seriously, a good plan that you stick with will beat a perfect plan that you abandon every single time.
So at the end of the day, this whole thing, it's not really a math problem. It's a know yourself problem. The best strategy is always the one that you'll actually stick with through the good times and the bad. So the question is, what's yours going to be?